Welcome back to the first episode of 2026 for the Real Estate Standard. I'm Tim Kotzman. This is episode 3 for the week of January 5th, 2026. I'm here with Kenny Alves and Chris Drizga, and we've got a few things to go over today. We have Kenny's going to provide an update on the West Main stacking, which I love the way we say that because it's West Main storage. But Kenny, have you ever considered changing the name to just West Main stacking, right? Something to maybe consider. Kenny's also going to do a year-end review, updates on the West Main dashboard, and we'll review a presentation on a refi strategy. Maybe a little bit of commentary on STRC, currently paying 11% payout. And on the news front, Walmart is now accepting Bitcoin at checkout. So interested to see if you guys have thoughts on that. Kenny, Happy New Year. Over to you.
Happy New Year, Tim. Yeah, we're gonna present the West Main self-storage dashboard. We wrapped up the year 2025. We got off zero. We've stacked over 2 Bitcoin, and we're ready to get rolling for 2026. We made some updates to the dashboard here. I'm just going to zoom through. I just want to make sure you guys can see, but we added mortgage coverage, which was a recommendation that Chris had suggested to see how many months of mortgage payments we could pay with our Bitcoin holdings. So we can see that we have about 9 months worth of payments. And then we also added some information where you can see our amortization schedule. We're currently on our 100th month on this loan, January 26th. And here's the breakdown of our principal and interest. This is all on our dashboard now. So we got some new analytics, and then we wanted to just kind of go over the year end here. We actually kind of tied, we kind of tied November as far as Bitcoin yield. We had 34% Bitcoin yield in December, just like we did in November. The difference was we started December with more Bitcoin. So that means we had to stack more Bitcoin to keep that same Bitcoin yield percentage. And you can see that in the Bitcoin accumulation chart here, where we surpassed. It was our best month ever of stacking, and that was because of the correction and pullback, but we're on the rise again. So we have our complete list of purchases for the year. We ended up with 23 weekly purchases, and yeah, that's kind of West Main in a nutshell. And we're getting ready this year. We're looking at refinancing the property, and we had a spaces last week or 2 weeks ago when we last met, where we went over some of the numbers. So I put together a little PowerPoint, a little slide, a deck to help people kind of follow along, because there's a lot of numbers, a lot of moving pieces. And yeah, but before we do that, I just want to let Chris jump in and say hello and see what he thinks about the feature requests that we implemented, and then we'll jump into this slideshow.
Yeah, thanks, Kenny. Happy New Year, everybody. I love the addition of the mortgage payments here, Kenny. Appreciate you adding that, and I think it's going to be really interesting to see this thing unfold over this year and beyond, and just to be able to kind of see the historical progression, essentially, of how powerful Bitcoin becomes to the real estate asset. So, when the last Bitcoin buy for West Main was last week Tuesday, if I'm not mistaken?
December 30th.
Okay, so we haven't had one for the 2026 calendar year just yet.
Tomorrow will be the first stack for 2026, every Tuesday.
Gotcha. Okay. My next request is I want to have like a rate of change metric for the Satoshis per square foot. That's the next addition to this dashboard for sure.
Okay, so percentage like increase week over week or something.
Yeah, I don't know just yet how we're going to interpret that or how we're going to utilize it in a tactical manner, but we'll figure it out as we go along. We've been
Yeah,
doing that here with everything else, so why not add it to the mix? But
that's another thing we can. Sorry.
no, I'm excited to go through these refi scenarios that you put together here because this is a really powerful strategy and it underscores the how Bitcoin improves and enhances the real estate asset. We've talked about a number of different categories the last couple episodes on how you can actually utilize and implement Bitcoin into the real estate asset. And this is the capital stack is probably the biggest component of a comprehensive strategy, whether that's your treasury management or utilizing Bitcoin in the loan structure. So I think I said on our last episode that I thought the biggest onboarding mechanism was going to be the collateral piece. And with the banks offering all these collateral options this year, hopefully, being able to not only have that access, but also, illustrate the power of the strategy with, something real like you have here, put some numbers to it, quantify the benefits. It's just going to make the case that much stronger and frankly that much easier for the real estate community and investor community to get on board with. So I'm really excited, like I said at the start of this, to see what the initial figures look like, and then be able to track them over the next months and quarters to see how things improve and change.
Definitely. Yeah, so I'm going to kick it off here. The first slide here, as you can see, it's titled Downtown Digital Manhattan, and that's kind of fun on Sailor's speeches. You can see here we're located in cyberspace as of last year. We got the address 825 West Main Road in Digital Manhattan. What we took away was if we add digital credit as a revenue source and add it to West Main's capital stack, we're going to increase our after-tax cash flow by 151,000 and by 41%. And that's a conservative metric. That's at today's rates. That's not in a scenario where we're able to get a loan that they lend more than we need to acquire additional Bitcoin, something like the folks at Battery are doing. So the next question is how? How do we get there? And we get there with digital credit like Strife, Stretch, Strike, and Stride. And today we're going to focus in on Stretch. We want to try to simplify this so as many people can follow along.
Kenya, let me jump in here. Before you go into all the nitty-gritty details, why don't you just give a 30,000 foot overview of what you're, actually doing here and, before you get into the mechanics, right? My understanding is you're evaluating a refinance on the storage facility, right?
Yes. So yeah, let me back it up. You're completely right. I'm kind of just drank too much coffee today or something. So what we're looking at is what do you most real estate folks, commercial real estate folks are looking to refinance at some point, pull out money tax free and reinvest into more property, or they have another investment that they would like to make. And so we're coming up on our time to refinance, and we wanted to evaluate what we could do with the cash from the refi. Obviously we could put it directly into Bitcoin, but that doesn't generate cash flow. So what we're considering is buying digital credit and adding that, and we'd be able to generate cash flow from those ROC dividends, those return of capital dividends. And it would basically be, in my opinion, like a digital building in cyberspace. So here on this slide, the way that I look at these preferreds are they're buildings for sale, and they have a perpetual ground lease and property management. So you never have to, find a property manager or do it yourself. You don't have to worry about renewing the lease, the ground lease, that is. Sometimes you see like these, national retailers do these 100-year or 50-year ground leases, and they'll build their own building. They might, love the location, and they can't buy the land, so they'll just lease it from you. And that's in New York how a lot of skyscrapers are owned. There's ground leases, and then somebody else owns the building. And in my opinion, that's what strategy is essentially doing. They're buying the land, and then they're constructing these buildings, and then they're selling the building, but not the land. It's just a ground lease, and it's a perpetual ground lease.
Bitcoin being the land and the perpetual preferred offerings being the buildings, just for clarity.
Yes, thank you for that. And feel free to interrupt at any time, Chris, as we go through this. That way we can hopefully dissect everything. So our current situation, we have a loan. We kind of went over this on the dashboard just a little while ago. It's at 3.66%. So naturally, we wouldn't want to refinance. And we didn't really look at refinancing because we had this, but it's good practice to do so. And looking, we found that even refinancing at a higher at a double the rate, from 3.6% to 6.4%, we can still increase cash flow. So I'm going to kind of walk through the differences here. So right now our balance on the note is 4.1 million. We would be increasing that. We would be borrowing, I didn't put it on this slide, but we would be borrowing like a total of 7.75 million, something like that. We would pay off the debt here, which is the 4.1, and we would have, after the refi, we would have, yeah, okay, it's right there, 7.75 million of debt. That would be the balance of the debt. And the proceeds would be 3.58 million. That's what we would have to invest. So we could invest that directly in Bitcoin, or we could buy some digital credit. In this example, we're going to be using the proceeds to buy Stretch. So that's the variable rate preferred that just got raised from 10.75% to 11%. I base the numbers off of 10.75% because I made this slide before the uh, announcement there. So it would just be a little bit better. And we're going to decrease our debt service coverage ratio from 2.79% or 2.79 times to 1.2. And that's kind of what the banks will allow. Did you want to comment on that?
And then I just wanted to, clarify that what you're doing here is you're introducing a third option, right? The real estate community is very well versed in doing a cash out refi to reinvest in more real estate, right? That is the tried and true strategy that has been perfected over the last 5 decades. Okay, great. The second option that we're now there that we have introduced is using those proceeds to invest in Bitcoin, right? Which is the faster horse in this race, and particularly if you're looking for appreciation, right? That's option number two. What you're doing here, Kenny, is you're introducing a third option, particularly for those investors that are more focused on the cash flow component, not necessarily the appreciation component. Is that a fair summary or observation?
Yes, because the Bitcoin, it's like unrealized gains or losses, depending on which direction it moves. And these preferreds are predictable cash flow, just like real estate is. You have your predictable cash flow, and you have great tax incentives, which is the ROC dividend, the return of capital. So you're essentially going to be swapping rental income for ROC dividend income, which is treated better for, when you do your taxes. So the next slide, we'll get into some numbers. These are real numbers, what we're currently doing in gross rents, a little over 1 million, almost 1.1. And when you take out the operating expenses, our net operating income, 746, and that would stay the same. Nothing changes there. What's going to change is that we have an additional source of income now, from the stretch preferred, where we're going to be collecting 384,000 roughly in annual dividend income, boosting our total income to 1.1 after expenses. Then we're going to look at taxable income here. So currently, after tax and our interest deduction, or sorry, we're trying to get our taxable income here. So we're going to deduct our interest expense, and then we're also going to deduct the depreciation. We don't have any stretch dividends from what I've found online. I still need to talk to a CPA. Maybe we can have Tim read this isn't financial advice, because this is just a pro forma here.
Ladies and gentlemen, what you're about to hear may be amazing, but it's not financial advice. It's for informational and educational purposes only. Kenny, back to you.
5% of the ROC dividends are taxable, is from what I found. So it's not 100% tax deferred from my findings. It's 95% tax deferred. But we're showing the difference here. You're dropping your taxable income by 62%. So currently our taxable income is 522,000. After this refi and purchasing the preferreds, our taxable income is 196,000. Next slide, we're going to look at after-tax cash flow. So currently our after-tax cash flow is 362,000. If we do this refi, our after-tax cash flow would be 513,000, a 41% increase. And, we're doing that at today's rates. And, I think there's room to improve that. So that's where we get those numbers. And, these are what we're considering for the next year. We've also kind of looking at, how this would impact our coverage ratio if our net operating income were to go up or down by 20-30%. So we can see what our cash flow would look like at that.
Kenny, before we get too far into the DSCR analysis, let's go back to that one overview of some of the side-by-side comparison, right? Because I think you went through that really fast, and I think these are some really important and powerful figures to highlight for the real estate community specifically. Because, I mean, you look at just this right column, the percentage change on your after-tax cash flow in particular, right? I mean, just under 42%. That is massive. And you didn't really do anything different to the underlying asset, right? You didn't have to push rents. You didn't, have to, do a big capex project. Nothing. It was just a creative, outside the box strategy with your financing, and that's something that you have regardless of the market conditions and other projects going on at the property. So I've mentioned it before. I'm going to say it here again. The real estate asset is used for a few different things, right? One is cash flow, two is appreciation and growing your purchasing power, and the third one is tax strategy. And with this loan refi scenario that you're laying out here, you're hitting on two of them, right? In a massive way, right? You're improving your after-tax position by, again, just under 42%. That's not a small figure. And if you go back a couple more slides, you improved your cash flow by what? Almost double? If I saw that correctly?
51%.
51%. I'm sorry. I was looking at something else. But so your taxes are improved by 42%. Your cash flow is improved by 51%.
Taxable income is down 62%. And then after tax cash flow is up 41%.
Exactly. So for the real estate expert, the real estate investor that's been through multiple cycles and has played this, buy, borrow, die game for, his or her career, this is something that not only speaks their language, but it becomes a meaningful strategy to consider right out of the gate, right? I mean, really the learning curve here, what everyone has to get comfortable with is that they got to spend some time, roll up their sleeves on, what the heck are these perpetual preferred offerings, right? What are the pros and cons, the benefits and disadvantages to each of the four offerings, right? Which one's best for me in my situation and my strategy, and go from there. So I think this is incredibly compelling. And the last thing I'll say here is, when we think about Bitcoin being the hurdle rate, right, at, whatever metric you want to use over a 5-year period, just call it 50% for round numbers sake here, you start to get in the territory where you're able to position your asset or assets in a way that actually exceeds that hurdle rate, right? Depending on what perspective you're looking at, right? But now this goes back to some of our initial comments, right? We're not saying real estate's going to zero. You need to sell everything, buy Bitcoin, and sail off into the sunset. That's not what we're talking about here. Right. And I feel like I'm beating a dead horse on this, but it needs to be said over and over again. Bitcoin is a new tool, it's a new innovation that is enhancing the real estate asset. And the strategies that work the last 30 years are not going to be the strategies that work the next 30 years. So you have to be creative, you have to be willing to do the work. And those that do and can come up with comprehensive strategies for the real estate using this Bitcoin tool are going to outperform not only the real estate community, but they have a really good opportunity at outperforming the hurdle rate, which this channel, we use the hurdle rate of Bitcoin for allocating capital and making investment decisions. So I think I'll stop there, but I wanted to highlight some of those metrics because they're incredibly powerful.
No, those are all valid points, and I do have some slides about Bitcoin as the hurdle rate, and so I'll keep it moving over here. We can spend some time on this, or we can kind of zoom past it, but it's just something that we look at when we're doing a refinance. Like if we did enter some kind of challenging time where our net operating income was going to decrease, what that would mean for us and our cash flow, and if we want to make sure that we can withstand some pullbacks here.
I think it's worth it. I like the stress test here. And, a couple things I want to comment on the debt service coverage ratio is, and go back one slide there, Kenny, too.
Sure.
1.2 is kind of your, historical average or historical equilibrium, dare I say. Over the last couple of years, just the challenges that have manifested throughout the commercial real estate markets, the lenders have very routinely increased the DSCR requirements. And that's just in a traditional real estate sense. So I've had clients and scenarios where I've seen that DSCR get up as high as 1.5, even 1.6. I know you got up to 1.44 here, so that's good. But if I'm a real estate person trying to poke holes in this strategy, one, or two, maybe I'm a lender that is still getting up to speed and getting comfortable with, my borrower using the proceeds to go buy instead of some of the more traditional avenues. Maybe in that scenario, as the lender, I say, okay, well, you're taking some undue risk here, and because of that, we're going to have a DSCR of 1.75, 1.8, right? Where it's almost, I don't want to say punitive, but it's got a fair margin above the
So I want to
broader market.
clarify. I want to clarify, Chris, that this is just based off the real estate cash flow. So this doesn't even
Okay.
I mean, I should double check that. There's a lot of math that went into this. I don't want to misspeak, but I'm pretty sure I backed out the dividend income here. So I gotta double check that, but I'm 99% sure that this is just real estate income. And that was something that, I'm interested in learning more about, if there are lenders out there that will allow you to use that dividend income, because then you're going to shoot up back up to a 2. You're going to shoot up to maybe a 3,
Yep.
because in this scenario you're just, the real estate is maintaining itself. You're not like this new digital property, this preferred stock that you're purchasing. You're not dependent on that cash flow for the property to fulfill its obligations. Just
Correct.
like you wouldn't be in a cash out refi where you go take that money and you build a new building, and instead you're buying land and you got to develop it, or you have to lease it up, and you're not relying on that cash flow for to service your existing loan on an old building.
Yeah.
Just
No.
wanted to clarify that.
No, I think that's super important, and thank you for doing that. That again, and I'm trying to be devil's advocate here. I'm not disagreeing with this at all, but again, I think we need to keep in the forefront of our minds here as real estate folks that, we're blazing a new trail, right? And there's going to be a learning curve for, the LPs, for the vendors, for the, banking partners, et cetera. And whether West Main can stand alone with the, its US dollar cash flow or not, right? There's going to be some scrutiny there. And
Right.
you as an operator, me as an investor, et cetera, we need to be prepared to have that conversation, not only at a high level, but also be able to get into the weeds and explain the rationale. The last thing I'll say here is, and this might not be specific to West Main, but when you look at some of these other real estate opportunities, if you're an operator, if you're a GP, you need to be very much up to speed with how your operating agreement reads, because there may be some specific language in there dictating, or even limiting what you can and cannot hold as a, reserve asset, right? That some of the folks that I've talked to on this topic over the last couple of years that have had existing investments, had existing funds, one of the challenges was, was exactly that, right? I can't go and buy, spot Bitcoin with some of my free cash flow, right? It violates the agreement that I have in place with my current investors. So that's a hurdle, right? And that's going to take time to filter out. Depending on the situation, maybe you can go to your, current investors, your current LPs, and make those changes. Maybe if it's a small friends and family type of scenario, that's a lot more feasible to do and accomplish. But if it's a scenario where you have 100 plus investors that, are just, it's a transactional relationship, going to him or her after the fact and say, hey, can we need you to sign off on this modification to the operating agreement so we can go buy Bitcoin, or we can go buy a perpetual preferred, right? So I just want to draw attention to that there are nuances here, and it's going to be very, very specific to, each and every situation. And the GPs, the operators, the managers need to do their diligence on that front.
Yeah, no, it could be difficult for some operators or GPs to get a Bitcoin addendum done. So it might make sense to start fresh, or
Yeah.
on the next project. But, we wanted to battle test this too. Like, what if things go south? What if in 5 years we're holding this and we've collected 1.9 and 1.9 million in dividends, but Stretch trades down to $56, and we have to sell for whatever reason. We have to replace the parking lot, or we have to do a big capital improvement, and we just need to liquidate. You can see that you'd still have a small return in this scenario. And we have a tool where we can play with the inputs, but just for the sake of today in this conversation, we just kind of wanted to give an example of, the worst case scenarios. And another way to look at things is through like a scenario matrix, where it's basically the same information we were looking at before, where you can see in this one where the interest rate, if that were to change, if it were to go up or down, and if the operating income were to go up or down. And you can see that you would have to, for you to start losing money, you can see in the bottom right hand corner is where you start to have like negative cash flow. You'd have to have a lot of negative things align. You'd have to refinance at higher rates than today. So instead of a 6.4, you'd be looking at a 6.5 or 7.5, excuse me, and you're looking at losing 25% of your net operating income. So it's pretty difficult to lose in this scenario. Another, tool is the Monte Carlo simulation, where we ran 21,000 iterations of interest rates going plus or minus 3%, and the net operating income going up or down 21%. And out of all those scenarios, 94% of them are positive. So, you have some pretty extreme cases like we kind of showed where it could go down, like net operating income could go down 21%, and interest rates could go up from here. And like that's what it would take to kind of lose. And if we're not going to go out and lock in an interest rate that is higher from today's rates, or at least we're not planning on it. So it just becomes, we're trying to find a hole in the strategy. We're trying to find where this doesn't make sense. We're looking for, the worst case scenario. And, what we find is, the worst case scenario that we can come up with, you're going to lose 4 grand a year. And then that's kind of West Main storage. And then I just wanted to kind of speed up because I know we're getting crunched for time today. But you kind of spoke about it earlier, Chris, sell or refinance. And when we first spoke, you were, telling me that, keep the good real estate in the portfolio, and sell the non-essential real estate, or like the lower performing real estate. And so, we have to, obviously compare what the difference is, right? So the Bitcoin accumulation is going to be very, like, to accumulate more Bitcoin than just selling is going to be very difficult. The dark orange line here is if we were to sell West Main Self Storage today, pay our taxes, pay the debt, we would end up with, roughly 60 Bitcoin. That depends on the price of Bitcoin, obviously. And the lighter orange line is if we were to refinance, buy Bitcoin, dollar cost average with our new lower cash flow into Bitcoin, and do that every 7 years, like refinance, pull out as much cash as we can and buy Bitcoin. You don't really catch that 60 Bitcoin. It's going to be a little bit less, but that doesn't necessarily mean it doesn't outperform Bitcoin. You can see here that the two orange lines end up in the middle, and I ran 20 different scenarios or so, probably run some more with different combinations, but there are scenarios where you refinance, you buy digital credit like Stretch, you take those dividend payments, and you buy a combination of Bitcoin and Strategy, or a combination of Bitcoin and Strategy preferreds. The ones that really only outperform Bitcoin, and this is if you think Strategy is going to have a larger CAGR than Bitcoin. So in this scenario, we put Strategy at a 40% CAGR and Bitcoin at a 30% CAGR. But with the tool that we have, we can, put that at whatever. We can put Bitcoin at 20%. We could put Strategy at 15%. And obviously things will change. But just for this scenario, there are paths in which you can outperform if Strategy outperforms. Keep it moving. This is like another one to kind of see out of all the different scenarios where, selling the real estate to buy Bitcoin is the dotted line here. So there are a number of different combinations that you could do, but you're going to end up with less Bitcoin. So it depends if you're more interested in cash flow. Maybe you have like a use for the real estate. Maybe you're generating a salary from the real estate, and there's there's other ways that you can leverage these preferreds. Like you could go to a brokerage and get an SB lock, a security back line of credit on your stretch. Maybe you're willing to take a 10%, borrow 10% of that to buy Bitcoin to increase your Bit. So you can get really creative, but it was just helpful for us to kind of visually see like all the different scenarios laid out and what it would take to beat Bitcoin. And it's it's not going to be easy to beat Bitcoin. So for most people, they may want to consider selling. But if you're depending on that real estate, if you want to keep that real estate, if that's something you can refinance and buy Bitcoin and dollar cost average throughout the years, hold on to your real estate. You're not going to necessarily beat Bitcoin, but you get pretty close to it. Hold on to your real estate and have a lot of cash flow.
I love the go back there one. I love the visualization you put together here. I mean, this is a very important and powerful representation. I mean, I must say I am a little surprised that the delta between the refi and the sell decision is so small. My knee-jerk reaction there is, West Main is a core asset, right? It's a high quality, well-maintained, well-positioned property in its subject market, right? And so, that's not all of them, right? So if you're a commercial real estate family or investor, you have a portfolio, all your properties are likely not, West Mains, right? You're going to have some one-offs, you're going to have some older stuff. So just being devil's advocate here for the real estate community. I mean, there's particularly for the ones that are not core assets, right? You have to factor into this analysis, ongoing maintenance, capital expenditures, fluctuations in lease rates, and ultimately the vacancy. I mean, the nitty gritty, the day-to-day operations of running a real estate property. And when you have one of those that, is not quote unquote core or not as well positioned as a West Main, some of these variables that go into this analysis, they're going to be meaningful, and they're going to have significant impacts on the combinations here that you're showing. They're going to have significant impacts on really the entire stack, the returns, the decision-making criteria, etc. But I mean, as far as we're concerned here, Kenny, I think this is a phenomenal start, and I think you're setting the standard for the future of real estate return metrics and hurdle rates. I love it.
Thanks, Chris. Yeah, just trying to get through this. I actually removed a lot of slides too, believe it or not.
I believe you.
So maybe next time if people are curious to learn more about this, let us know, and we'll do a more detailed episode. But just wanted to be able to get some visuals in front of people while we talk about this because it's a little bit more helpful to follow along. And
Mhm.
here is a time chart in which it would take to outperform Bitcoin, or when it not outperform Bitcoin, but to outperform selling the property for Bitcoin. So it could take decades to to be able to get what you could get right away, in a sense. I mean, when you sell it for Bitcoin, that Bitcoin's not going to be worth what it's worth in 21 years from now. But if you convert it to dollars, it's going to take a minimum of 13 years or so to be able to surpass that, sell the property for Bitcoin. So that's just a visual on that. Okay. Here's one scenario. Here's the money flow, like how it all works out. So you can see that the weekly DCA goes down, and in this scenario, I just kind of picked a random one here. This is STRC being split into Bitcoin and MSTR. So the dividend payment and the dollar cost average from the real estate are both being chopped up in half and allocated to equal parts Bitcoin, equal parts strategy. And you can see that at the end, you end up with significantly less Bitcoin had you sold than just taken the Bitcoin. But in this scenario, you end up with a lot of strategy shares and you still have your stretch shares. And you can see in the bottom left, every 7 years, you're going to do a refi. I just kind of use the same number. You might be able to get more or less depending on interest rates and your, net operating income if you're able to increase it over those 7 years. But you can see that you'll still end up with cash flow. I got to kind of look in here. So your final cash flow in 21 years would be you'd be earning 1.5 million off of the preferreds because you're gonna buy them every 7 years with the refi money. But there's all different kind of simulations you can run, and I'm not saying this is the best one. I'm not saying, this is the way to go, but definitely worth considering versus just dollar cost averaging Bitcoin because you don't have that tax advantage from the business point of view. You don't have the cash flow, which a lot of people need to survive. And then here's another visual on, comparing selling versus the STRC 50/50 split into strategy and Bitcoin, that at some point you're going to surpass that. And then kind of want to wrap it up here, but the the question came to me, why would strategy sell their buildings, right? Like, why would they offer this? And you kind of alluded to it earlier, but if we think of Bitcoin like the land, there's land for sale and it's 10 cents per square foot. And if you do it by the acre, it's 93,000 or what, it's fluctuating a little bit. And that's just trying to compare Satoshis and Bitcoin to square footage and acres. And the reason why they would be willing to sell their buildings is because they want to buy more land to build more buildings. And there's a fixed amount of land, right? They're not making any more of it.
Mhm.
So it's like a race to get as much land as you can. So you have all the time that you need to build the buildings. You don't have all the time you need to acquire the land. That's kind of the reason that I came up with why they would be willing to do something like this. And that's the PowerPoint.
Very nicely done. I think what this, if I'm just taking a step back, I mean, what you just demonstrated here today is one of many approaches and strategies you have, at your disposal, or at least on the table for consideration, right? Depending on the property, depending on the market, depending on your particular situation. And, Bitcoin aside, one of the things I enjoy the most about commercial real estate is um, how creative and specialized people can get on on an asset or on a portfolio. So this adds a completely another dimension to all of that, and it gives it's going to be really really exciting and fascinating to see how people come up with their approach and their strategy. The other thing, and this will kind of be my closing thoughts here, guys, but the other thing that I think we didn't specifically touch on, but it kind of underscores another theme we've been talking about, and um, it maybe we bring it up on our next one, but the interest rate sensitivity analysis slide there that you put up, Kenny, right? I mean, what's going on here in the real estate industry today and over the next 5, 10, 15 years, over the next couple of cycles, is there's a complete recalibration of how we value real estate, right? And again, you and West Main are ahead of the curve here. So, setting you guys aside, the average real estate investor, small, medium, or large, their return profiles need to change significantly, right? The returns need to decompress, from 5 to 7% to almost double, right? Because you're getting to a point where you have, I know this month's stretch is paying 11%, but you're getting to a point where the broader market has options that are don't carry the same risk and don't have the same management intensity that real estate does, and they're paying double, right? So again, when you go back to thinking about raising capital for your next deal, the property across the street is not your only competition, right? Your competition is the property across the street. It's Bitcoin. It's these adjacent products, and then it's now the West Main storages of the world that are fusing the two together and generating 40-50% return metrics. So again, we're blazing a trail here, and we're not claiming to have all the answers. This is not financial advice. Do your own homework on your own asset, but this is where the real estate community is going to need to head if they're going to remain competitive and relevant into the immediate future.
Yeah, well said, Chris. And I'll guess give my closing thoughts too here. This, you know, it looks like a 41% return in cash, but it gets even better because if you're sweeping that cash into Bitcoin and Bitcoin's doing 30% or a combination, right? You're actually compounding that 40% even more. And I mean, any business that is like vertically integrated with the real estate can do this, right? And be that much better than their competition. So what does that mean? That means if you want to go acquire more real estate, say if you get a lot of interest from limited partners because you stumbled upon this strategy and they want access to this type of deal flow. Well, now you can go buy up the storage facilities or the shopping centers that are coming to market, and you can outbid, not that you want to, but you can outbid your competition because it's worth that much more to you. If you're able to increase cash flow by 40%, you'd have to refinance the property. So it's not like you're going to get that immediate savings. You're going to have to buy it, operate it for a number of years before you can pull out, but that payday is kind of coming. Um, so it just kind of, like you said, it flips everything on its head, and you got to evaluate all these different scenarios because digital real estate is shaking things up.
Absolutely. We got to run. For Kenny Alves, Chris Drizga, and myself, this has been episode 3. Thanks, everybody, for listening and watching, and we'll see you next week right here on the Real Estate Standard.